Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Chad Griffiths. Chad has been an industrial real estate broker since 2005 and an investor since 2014. And in just a minute, we're going to speak with Chad about industrial real estate. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Chad. Welcome to CRE PN Radio.
Oh, thanks so much for having me on, Darren. I got to say, you've got one of the most amazing radio voices I've ever heard. As you're natural for a podcast host.
Well, I appreciate that. Hopefully the content is rich and people come for that. But I appreciate that. Chad, I'm looking forward to our conversation today. Before we get started, if you could take a minute and share with the listeners a little bit about your background.
Yeah, so I started in real estate when I was quite young. I actually started in residential real estate, investing in around 2002, 2003 with a few friends, and didn't really make any money, but didn't lose any money either. But I had the itch to get into real estate more. So I started by actually joining a residential brokerage. Did that for about a year in 2004 and just didn't really see that as being a long-term career path for me. So I reached out to a few people that I knew and got started as a commercial real estate brokerage in 2005. That brokerage was heavily focused on industrial real estate. So that's just naturally where I got put into as well. And I like to say that at the time, I had no idea what industrial real estate was. I was a complete layman going into it. And I thought I'd be maybe working in office towers or retail strip centers. And it was just by pure luck that I happened to join in a brokerage focused on industrial. And it was such a great turn of events for me because I've been doing that now for 16, 17 years. And it's been an absolutely wonderful experience. So broker for the last 16, 17 years. And then I started investing myself in 2014. And with a series of partners that we have, where we've pretty much added one property a year. So we've got a pretty good portfolio going now, including we just closed on one about a month ago now for 4.1 million. And that's a multi-tenant industrial building right in the city that I work in.
Sweet. That's great. I love it when people are able to not only work in the space but also invest. I think it's always exciting to see others doing it, but to actually be in and be able to participate is that much more exciting. I wonder if we could start here for a second. You mentioned when you first started that you did not even understand what industrial was. For our listeners, I wonder if you could just kind of take a second and kind of give some parameters on what industrial is and what it's not.
Yeah, great question, Darren. And that's a natural place to begin because I think a lot of people are starting to learn more about industrial, just with the rise of Amazon and e-commerce and all these big distribution centers. I'm sure it's the same in Portland as it is all over North America, where we see these massive distribution centers going up in higher profile areas. Like in my market, there's a 1 million square foot Amazon fulfillment center right outside the airport. So it's visible for everybody. So now you can't miss this 1 million square foot building right off the highway. So now it's on a lot more people's radar, whereas traditionally these industrial buildings were tucked away more in industrial parks. And that's by urban design. The planners will intentionally try to segregate the industrial parks from residential and even other commercial parks, just because they can be noisy, or they can smell, or there could be more vehicle traffic, like semi trucks coming and going. So by design, these industrial buildings have been out of the public view, where now we're starting to see them pop up all over the place. So I think that that's a good place to get into it. Is the first one, which more people are becoming familiar with it now, are those distribution centers. And I would categorize that into, I usually break industrial real estate down into three main categories: warehousing, manufacturing, and flex properties. And those distribution centers will usually fit neatly into that warehousing category. And that's all the properties where things are basically stored, or they can be repackaged. Could be a shipment of trucks bringing stuff in, then it's repackaged, put into different categories, and then shipped out to somewhere else. Those are typically going to be a warehousing type of property. The other one, which is just as big and just as prevalent, but outside of that public purview, are the manufacturing properties. And a good example is one actually not far from you, the Boeing Everett factory just outside of Seattle, which is a 4 million square foot building. And it takes a bit of mental effort to actually understand how big a 4 million square foot property is. But all that they do in that property is all the raw materials for the planes come in, the planes are assembled and manufactured, and pieces are all put together, and then the finished product, the plane, will go out the door or on its way to the customer. And that's a traditional manufacturing property, which is a massive building. But they can be all the way from a 4 million square foot building down to a 2,000 square foot industrial bay. There's a wide assortment. I think that that's what a lot of people don't grasp without having some intimate knowledge of it. There'd be no reason that anybody would know this, but there's a full spectrum of size on this as well. And on the last category is flex properties. And I consider that to be more of like a miscellaneous catch-all for industrial properties. It'll usually be a property that's zoned industrial. So the municipality will give it an industrial type of zoning, but it might not be conducive for warehousing or manufacturing. So it's still an industrial zone property. It's probably either in an industrial area, or it might be on somewhat of a higher profile area. But the key is that it's still an industrial zone property, but it could be a wide array of uses. And I've seen, just to give a few, just for context, I've seen churches in industrial zone buildings. Car dealers are another great one, because at the front, they've got their showroom for all the vehicles, but at the back, they've got a warehouse for working on all the cars or storage. It's really just an industrial building that has higher profile exposure to a main road where car dealerships like to be. Bottle depots I've seen in industrial buildings. Self-storage is another common one. Art galleries. There's a ton of uses that can, provided that the municipality will let that type of use into the zoning classification that they've set for it. You can put a number of different uses into a flex industrial property. But those would be the three main ones. And I would say the bulk of them will be either a warehousing or a manufacturing property, but flex is still a huge category into itself.
I don't know. I really appreciate you breaking that down, because I think there's maybe like a fuzzy idea of what it is, but to have a more clear picture, it certainly helps. And I think kind of what I was picking up on what you were, as you're breaking it down. So industrial is basically the class, and then in it you have these subclasses, which, the distribution, manufacturing, or the flex. And then is the zoning, then does that determine the occupancy possibilities, or is industrial, like if you came to or if you looked at your local zoning and it says industrial, is that then what can fit in that or what can occupy that space? Is that determined by the city then, or is that under industrial, anything goes? That's one of those that you've mentioned.
Yeah, every city will have their own guidelines on how they set their regulations or their bylaws. But going back to the point about this being an urban planning exercise, the cities are want to have the ultimate control over what's going to go into that building. And it's just for the purposes of avoiding having a heavy manufacturing facility right next to a residential neighborhood. That would just cause problems for everybody. There'd be nonstop complaints, and it'd be something that they want to avoid. So every municipality is going to be a bit different on this, but the idea is that they'll have within the main zoning categories, industrial being one of them, there'll typically be a few subcategories of zoning. So in my market, as an example, we've got light industrial zoning, medium industrial zoning, and heavy industrial zoning. And we also have a business industrial zoning. But for the purposes of just making this as simple as possible, if we just focus on light, medium, and heavy, every municipality, or most municipalities, I should say, are going to have some sort of ranking system like this. And a light industrial property, it could even just be a straight office use. There could be an industrial building that is leased just to office tenants. So the intensity of what's happening in there is actually quite low. As you start going up that scale, medium industrial, you might see some more heavier uses like an auto mechanic, or some sort of use that will have more traffic or more noise. And then once you get to heavy industrial, that's when you can get into like a heavy manufacturing property where they're welding or machining. Those ones are typically going to be as far away from that residential base as possible, but for good reason. The municipality is going to want to, or should, I might even go so far as saying they should control what's going into each individual building that they assign a zoning classification for, just to avoid the problems of neighbors not liking each other because one's residential and one's a heavy manufacturing. They just try to keep that relationship as clean as they can.
Yeah, no, it makes complete sense. I mean, just some sort of a buffer between, the different classes, and especially when you get from residential to any kind of manufacturing, I think there's, makes good sense to have some sort of a barrier. You wouldn't want little kids playing in areas where there's big heavy trucks, and I can't imagine it's enjoyable if you've got around the clock manufacturing, clank clank bang bang boom boom, horns and all that kind of stuff. So that all makes sense. But I appreciate you kind of breaking it out, because it's like, I think sometimes when you mention like a manufacturing, like a Boeing plant, I mean, it's like, holy moly, that's huge. Um, and just as far as the opportunity for an investor to get in, I mean, a 4 million square foot building is probably not likely to be owned by an individual investor. Uh, and that kind of brings me to the next question. Of the different classes you mentioned, the distribution, manufacturing, and flex, is there any weight that you would be able to assign that you would think that the percentage of occupants are owners, uh, versus more of an opportunity for an investor that's not the occupant to buy and be a landlord?
Yeah, instead of even focusing on the categories themselves, I think it's almost going to be size dependent, because the price is going to rise in proportion to the size to some extent. The more expensive the property is, and the larger that it is, the more economies of scale are going to be there. So the price per square foot might go down a little bit as you get bigger, but generally speaking, a 200,000 square foot building is going to be a lot more expensive than a 2,000 square foot building. So I think size wise is where people would most likely want to focus. Like it's going to be unobtainable for the average investor to go in and buy a $20 million building. Whereas some of these smaller ones, and I could speak about the first industrial property that we bought, my partner and I, was a 2,000 square foot industrial condominium. So same type of ownership structure as like a residential condominium or strata, where the building is broken down into legal units. That was the same with ours. It was a building that's about 30,000 square feet, and this one bay in the building was 2,000 square feet. And by the time we had closed on that and we had to fix a few issues in there, we were into that for about $400,000. And that we actually still own that property to this day. That was the first one we bought in late 2014, and we still own that one. And it was a $400,000 condo. It was very small. I think we put down 100 grand or so between the two of us on that. Got really favorable financing on it. We've had one tenant in there for 5 years, and then we've put another tenant in there since. And that's been a really good little industrial condominium for us. So I think it's you could have different categories. Like you could find a warehouse that's a 2,000 square foot warehouse where tenants can come and just store, smaller tenants can come in and store stuff. You can get a manufacturing bay, you can get a full flex property. We've got everything actually in our portfolio. We've got residential, or not residential, my apologies. We've got warehousing, manufacturing, and flex properties in our portfolio, and they range from that $400,000 to the biggest one we have is about 5 million. But we have partners on that as well, so it's not just all our own capital, and we've got bank financing on it as well. So we've scaled our portfolio now, but it's been over time, and we've intentionally sought out the properties that we could afford as opposed to just focusing on warehousing or manufacturing.
No, that makes sense. And especially like you mentioned, just the size of the property kind of predicts the price and the opportunity for the investor. Um, Let me ask you. So we talked a little bit about individuals, and it sounds like the larger properties I don't know, maybe all of the properties you've had a partner on in some way, shape, or form. Um, I know, there's multiple ways to do it. Uh, Go solo, partner, or joint venture, or syndication. Are you doing any syndication? Are you doing joint ventures? How are you going about acquiring properties?
Yeah, we're doing it all through corporate ownership, corporate partnerships right now.
Okay.
So we're not into the syndication stage where we're sponsoring a deal, and that's been by design, where we've just wanted to first build out a track record for ourselves, so that at some point down the road, if we ever do decide to sponsor a deal, then we could be confident as the GPs and try to attract LPs and give them the comfort that we have a good track record. And we've just been fortunate. We've been in a position where our partners have come in as equity partners, and we've gone in as equity partners as well. So it's just been a good arrangement with some very close friends of ours. But at some point that we would like to do that, just to scale the ownership portfolio beyond what we have right now. It probably is on the radar, but it's been a very, very close group of friends and colleagues that we have invested alongside us right now. And we'll just set up a new corporation that will hold the real estate, and then our individual holding companies will own the proportionate share within that, which has just been a good structure for us without having to get securities lawyers and everything that entails a syndication involved in it. So we're just trying to keep it as simple as possible for the time being.
Yeah, I love simple. Keep it simple. So let me ask you on the different properties in that, a lot of times when people buy a property, they have some sort of a strategy, maybe to improve the economies, value add kind of a strategy, or at least that's a real common one with like multifamily and office or retail. Is there any kind of a strategy like that when you go and acquire an industrial property, or are you basically just looking at, here are the numbers, we've got scheduled rent increases, let's see if we can't fill the vacancies?
Yeah, great point. And I'd put that on a spectrum, right? On just the amount of risk tolerance that an investor has in relation to the upside that they envision. So I'm a pretty on the one end of the spectrum. I'm a pretty conservative investor myself. So I like buying properties that already have some element of stabilized cash flow. So I don't have to take on the risk of waiting to find another tenant and the risk that accompanies that. So I've been a pretty conservative investor. Most of the stuff that we've bought has had tenants in it, or we had a really high degree of comfort that we could backfill some of the individual spaces. But I like the idea of having cash flow. Get, like you said, if you have some rental escalations in the lease, you can get that top line revenue growth just organically. If a vacancy does come up, you might be able to do some value add over time. But on that other end of the spectrum, it might be somebody buying a derelict old building that's vacant, and they're going to do a full renovation and reposition it, and then try and find a tenant. To me, that comes with a lot of uncertainty, and I would, especially since I'm deploying my own capital into this, I would just rather have the comfort of that cash flow certainty in exchange for not getting as high of a return as the guys that have higher risk.
Yeah, no, definitely the risk reward, and from what I understand, the demand for industrial is like limitless. Are you finding that to be the case in your market, that there's just so much demand?
It is crazy. In the 16 years that I've been in this business, I've never seen anything like this. And that even includes like 2013, 2014, which was a pretty hot market. There's just an insatiable appetite for e-commerce around the world. Everybody's shopping on e-commerce. This last 18 months that we've been through have really accelerated that trend that was already gaining popularity pre-2020. So we've just seen so much demand for warehouse property, not even just in the coastal markets and like along the whole coast where you are. Like if you start looking at some of those markets there, the vacancy rate is sub 1%. And when you get into a sub 1% vacancy market, there is essentially no vacancy. It just almost becomes like a rounding error to say it's zero, but there might be a little bit out there if you're really lucky. And we're even seeing that start to creep into more inland markets as well, where Dallas right now is a good example. Dallas is probably leading North America in the amount of development that they have underway because they're at historically low vacancy rates themselves. And that's in an inland market. So we're seeing that across the board. There's still pockets of vacancy in many markets. It's not nearly as bad in Dallas for a vacancy rate perspective as it would be in Los Angeles, but there's still a lot of demand. And given the long turnaround time right now to actually get a product from just a piece of dirt all the way up to a finished building, there's constraints in the bottleneck to get building construction materials like steel. It's just making it cumbersome for these guys to actually build as quickly as they want to. So even some of this inventory that's planned or in the process of going up, it could still face 12 to 18 month delays. So I would expect that we're going to see a lot of demand continuing for the next number of years, and the supply will try to catch up to it, but it's only going to be able to catch up to it as quickly as the developers can build. And I suppose to some extent that leads to a potential problem down the road. And you and I both know that the development community has a propensity to keep building until someone tells them that they shouldn't build anymore. And that's usually in the way of vacancy rates rising because they just overbuilt. So that could be a problem at some point down the road. But if you believe, and I believe myself anyways, is that e-commerce is going to continue to slowly take away market share from the traditional brick and mortar retailers. So I think this trend will go for some period of time still, but at some point down the road, whether it's inflation, interest rates having to rise as a result, or just overbuilding, there could be some uncertainty at some point in the future. But from my standpoint, I'm not making decisions based on what might happen in 5 years. I'm just trying to make the best decision I can with the information I have available right now. And that information says that industrial real estate should be a very hot commodity for the next few years.
Yeah, that's consistent with what I'm hearing. I'm curious, there have been some, at least here in the States, and I would assume that it's true up there in Canada as well, but some of the large retail centers have kind of lost their pizzazz. Have you seen any conversion of those types of properties into maybe a light industrial warehouse option? I don't know if that's plausible. Just to me, it's always been amazing how some of these retail malls were, huge, and to just have them go dark or be knocked down just seems kind of like, there should be some sort of an opportunity there, but maybe not.
I think that will be a big trend going forward. We're not seeing as much in my market, and I think it's more a reflection that we don't have as much retail inventory per capita as some markets in the States do, where there's going back to that overbuilding problem. Like retail for the longest time, developers just loved building retail shopping centers, and they were all everywhere you go. It's you'd look at a shopping center, and I found anyways in the US that there's just a lot more retail per capita. So we're not seeing that as much. In fact, I was at a mall the other day, just getting some gifts, and I couldn't believe how busy it was. So I thought the same thing. We're in this middle of this once in a century event, and everybody's ordering stuff online. But here I am in a shopping mall, having to wait to get a parking stall, having to wait in line to pay, and I couldn't even believe it. But I think that e-commerce will still continue eroding that market share. So I think that that's going to be a trend that happens all over. And to your point, that this is already on the radar of a lot of these big distribution companies that want to get that last mile delivery service. And that last mile delivery is essentially it's not an actual mile. It's just used to describe the final stage of getting that product. So it could have come from across the ocean on a container ship. It could have come across the country by train. It could have went to a factory by a semi truck. But there's that last stage where it gets from that final warehouse or final retail store to your front door. And what a lot of these distribution companies are trying to figure out is how can we do that as economically as possible? And in many cases, there are all these underperforming malls, especially in the US, that are strategically located in communities. That's where a lot of these shopping malls have set up. So I think that there's going to be a big appetite for these distribution companies to figure out how they can economically enter into these shopping malls and convert it into a giant warehouse distribution center. But the challenges that they're going to have to overcome are, first, can they pay the retail rates that the landlord might have been receiving from the previous tenants that were in there, or does the landlord just recognize that any rent is better than no rent? And then there's also going to be some zoning ordinance challenges on how they can convince the municipalities to allow it to go from a commercial use to an industrial use. And that's not easy. I'm sure you've dealt with this as well. You start getting into all the red tape and bureaucracy, dealing with a city and trying to get them to change their minds on how they do this is not a quick or easy or certain process. So there's still going to be a lot of hoops that go through there, but it really is a perfect setup if for these distribution companies that need that last mile logistics. These shopping centers are in a fantastic location for it. And typically they have high ceilings, there's lots of parking, so that it's set up for it. It's just there's the economic factor, and then there's the uncertainty of dealing with a municipality. But I think that's some great insight, Darren. Is that you're 100% right on that. That will be a trend that we should watch going forward.
Well, the facility itself, to me, it makes a lot of sense. But as we're talking here, and I'm just thinking about the traffic and the zoning, would probably be one of the biggest pushbacks, because if you've all of a sudden got what was a retail center, and now you've got semi trucks backed up
Mhm.
forever trying to get in and out of that property, I could see a little bit of resistance to that. I guess if a property were situated close to interstate or major roads, and it was something easy on, easy off, it might be an easier sell. But I could certainly see if it was deep in some sort of residential section, there'd be a little bit of pushback on that. Which if you've ever there's I think it's a FedEx uh, distribution center near where I live, and if you've ever been in the morning traffic trying to, go through that zone where they're pulling out, I mean, it's like there's just like a line of these trucks, pulling out through that one light, kind of thing, on
And
their way for the day.
they're not quiet there. So yeah, it's
Yeah,
intrusive for just how big they are and how much they block the road. But they're loud. If they're hitting their brakes or just backing up, the sound of backing up. If you're in a house next to that shopping center, you're not going to be very pleased to have that tenant move in there.
yeah. No, it as I think more about it, it's like there's definitely some method to the madness, and to try and keep the peace, if you will, kind of thing. So, but yeah, it seems like there'd be an opportunity for those, um, the failed retail centers that are further out. I often think of Kansas, where I grew up, and the retail center where I bought every pair of Levi's and every pair of shoes that I ever wore growing up. They basically went dark and they knocked it down, and I think there's a Lowe's there. But that overbuilding of retail was, a lot of it was accelerated based on the way that there was no like land use laws that prevented the urban sprawl or the suburban sprawl. And you had this just ongoing, and basically the valuation of your residential property was directly proportionate to how new it was.
Hmm.
So every couple of miles there'd be another intersection looked just like the one you went through a couple miles back, and it would have a Starbucks on one side, and you know the grocery store, and all that. And but there was kind of a recognition, I think, over time, where people started going like, we're really a long ways out, and so there was kind of this migration that's kind of started back in, and as that started to occur, some of those further out retail centers lost some of the support, and I think they went dark, and that to me, that would make sense for those to have a chance based on the traffic patterns and where they're located in proximity to a major thoroughfare and just based on the space, it would make a lot of sense. But interesting though how that like you said, the most developers don't stop until somebody says, stop. There's
Well, you could see the problem that retail is having right now is that they've got waning demand just from losing some market share to e-commerce, and they have too much supply. And I mean, just basic economics will say that that's a bad problem. And right now that's afflicting retail, but you could extend that to office. Same problem. There's a lot of uncertainty how much office is going to be needed going forward, but they've got a lot of supply. Whereas industrial right now, it's the opposite problem. There's increasing demand and there's not enough supply, but it's cyclical. Like I wouldn't be so naive to think that industrial is going to continue growing at this rapid pace indefinitely. Nor did retail, nor did office. So there will be some turning point on that, but it's how long out that is and what the implications are, and whether it's just a temporary setback or whether it's more systemic. It's really hard to extrapolate that far out into the future and know what's going to happen. So I'm kind of trying to make my plans based on like short and medium term objectives, and just I guess maybe it is naive, but just kind of hoping that things work out over a 10-15 year time horizon.
Yeah. A couple of questions I have for you about the deal. Lending. Is the lending environment favorable for industrial? Is it what kind of terms are you seeing on a regular basis?
It's definitely very favorable from the capital market standpoint, but it's not necessarily favorable for buyers that are new into it. And by that, I mean, a lot of investors that want to consider industrial probably have some multifamily background. And that's just seems to be the path that a lot of investors take that get to industrial. Not saying that everybody does get to industrial or even wants to, but for the ones that do, it's this first time, or the small investor anyways will usually have a couple of houses. They've made some money, then they'll parlay that into a multifamily project, and then maybe they want to diversify, so they start looking at industrial. When you compare industrial financing to multifamily financing, there's a lot of really good financing packages you can get for multifamily where you can be putting down much less from a loan to value perspective. Whereas in industrial, you're still looking to be probably in that 25 to 35% down to buy an industrial property. And that's using conventional bank financing. If you wanted to get a second mortgage or do more aggressive terms, there's certainly lenders out there, but you're probably paying anywhere from 400 to 800 basis points higher on your interest rate. So it comes with just a lot more risk. So what a lot of investors do is they want to get that conventional financing where we did one renewal on a term that we had last year, and we got 2.57% on I think we did a 4-year fixed on that one. So you can get some like really cheap money, but those are ones where you have 25 to 35% either down payment or equity in the property if you're refinancing it. So it's whereas like multifamily, you can get much higher loan to value ratios. So I think that might be the one surprising part. But the thing that I like about industrial is that if you're putting down that much of a down payment and you're getting really good terms, you're cash flowing right out of the gate. Like we've cash flowed on every single property that we've bought from day one. We didn't have those issues where our loan was so high that it was stressing the cash flow coming in. We've cash flowed on every property. And then once you couple paying down the principal, and if you can get some appreciation in there, those three factors, the cash flow appreciation and mortgage pay down, if you can hold that property long enough, it can be a very lucrative investment. But people have to wrap their head around the fact that you're not going to be able to get as high of a loan to value in industrial as you could in multifamily.
Yeah, and I think that's creeping into the mindset as far as multifamily, just based on the concern of interest rate increase or whatever. I mean, the demand and the pricing still going higher, but just to get your debt service cover ratio to be what the bank wants, they're looking for a little bit more down payment or equity in the deal. So but I don't have any issues with that. I mean, being conservative on that, I think that prevents us from having another cratering event that just totally undoes the market. But that's I appreciate you sharing that. What about and I wanted to ask you, are those 25-year amortization
Yeah.
terms, or
Yeah. Thanks for asking that. That's an important point as well. Yeah, industrial it's much more common to see 20-year am on
20?
deals. Newer properties you could certainly push to 25. If it's older, a lender might even try to push that down to 15. But the most common that I've seen as a broker and an investor would be 20, and everything that we have is 20-year amortizations.
Okay, well, I mean, you're building equity that much faster, so
Yeah,
that's
exactly.
that's good. Good. Let me ask you about underwriting your tenant. In a residential multifamily kind of thing, you're looking that they have a job, and any prior evictions or convictions, or how was their past experience. The little bit that I've looked at industrial, I mean, I've come to recognize that the value of the property is directly correlated to the quality of the tenant. At least that's kind of my perception on that. Can you speak a little bit to that?
Great point, and I would have been on that same mindset as you until recently, actually, where I was talking with the regional. I can't even remember what his position was, but he was essentially in charge of industrial acquisitions for a very large fund, like in the tune of $6-7 billion. And I was talking to him on that very topic, and he said that he's more concerned with the building itself than who the tenant is in there. And his mindset was that if it's a good building in a good market, you're always going to be able to find a tenant for it. And if you take the approach that a tenant is always going to have moving on their mind, and I think that is a reality, is every tenant does think at some point about moving, because if they weren't, then they're not in growth mode, or they're not in expansion mode, or they're not in repositioning their business for optimization. Every tenant is thinking about moving at some point. Now, they might stay for 30 years, and that's great, but the tenant might also stay for 5 years, and at that point you're going to have to get another tenant in there. So his position, and I'm coming around to this as well, is that the building and how the building is set up so that it can attract future tenants at the rates that you need is more important than the tenant themselves. And I think that that's from like a institutional mindset, which this fund would fall under. I think that they can do that because it's investor money, and the people that are managing are making a salary, and they're going to make a salary regardless of whether the building's at 90% occupancy or 100% occupancy. Might affect their bonus, but they're still going to get paid. Whereas a small investor like myself, I need that cash flow right now. I need that cash flow to support the debt. I need that cash flow so I can keep reinvesting it and into deferred maintenance and all the things that come with it. I'm hypersensitive to that cash flow that's coming in right now, whereas the institutional guys aren't. So I balance that short-term mindset about needing to have cash flow by the long-term objective that at some point the tenant could leave. The tenant, they could go bankrupt. There's big companies all the time that go bankrupt for reasons that weren't clear at the beginning, and it was a surprise. So that is a factor. Or they could just leave once their lease term is up. So I look at it that cash flow up front is vital for me as an investor, as with my own capital in it and bank obligations. But I also do want to have a property that is releasable or sellable down the road in the event that they leave. In terms of how you can look at a tenant and underwrite them as a viable entity leasing space from you. I think the easiest way is any information you can get from them on their financial statements. If you can get 2 or 3 years of financial statements, you can decipher pretty quickly how much they have in retained earnings, how much they have sitting in cash, what their expense line item was for rent previously. And you can get a pretty good sense of whether they're capable of paying their bills and they have a history of paying their bills and can continue to pay your rent. And you can supplement that by getting references from their banker, previous landlord, anyone else that can help give you some comfort. But there's undoubtedly risk that comes with renting to anybody, whether it's a small mom and pop manufacturing company all the way up to the biggest company in the world. There's some area of risk, like Sears. Who would have thought 50 years ago that Sears would have went bankrupt, but it did. And in context of history in a very short period of time, they did. So I think that is just a risk that comes no matter what you're investing in, and into that large institutional investors mindset. If you take the approach that is a risk, that the tenant can leave at any time, but the underlying real estate, the property that you have, so long as it is competitive with the rest of the market, and you don't have huge expectations of overperforming what your neighbor's property might be leasing for, you'll always be able to find a tenant. So I balance both of those. I know it's a very long-winded answer to your question, but I do think it's important in industrial to have that short-term outlook, especially if you're like a smaller investor like myself. That cash flow is key. You need to have cash flow in, but you also need to balance that out by having that long-term vision that tenant will leave at some point.
Yeah, no, it's part of the cycle there.
Mhm.
But no, I appreciate you sharing your thoughts on that, because it's again, not having looked at it so closely as a potential investor in the past. I mean, the little bit that I did, I was like going like, wow, this. And if you've got a lease that's like a 10-year lease, that's worth a lot, as opposed to one that's got 6 months left on it. I mean, I'm kind of, as I'm understanding, there's, if you don't know if the guy's going to stay, and having that empty place, and possibly a market that's not in big demand, that could be a buyer beware kind of thing. But if you know I mean, obviously you got to know your market. You know your market, know the demand and the supply. I mean, that's kind of the starting point. Is you got to have a good base knowledge of the market you're in, and how easily it'll be to fill the space. That's good. Chad, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies that we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. And I like to ask my guests if they can look at their own situation. You can frame it however you want. It could be your clients, investors, tenants, the market, politics. But if you can take a look at your situation and identify what you consider to be the biggest risk. And for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. But if you're willing, I'd like to ask you, Chad Griffiths, what is the biggest risk?
Right now, as I see it, the biggest risk is that we are forced into another shutdown or lockdown in the market. And I hope that doesn't happen. I think everybody has fatigue from this past 2 years that we've been going through this. And I think everybody wants to get back to business. But I think from the standpoint that if the medical community starts making more issues of this, and if some faction of the public starts pushing for more measures, then I can see that happening, unfortunately. If it is for good cause, if that is the best course of action and people agree on it, then it is what it is. I'm not going to argue it. I'm not going to be that guy with a pitchfork out there saying we can't shut down. I really hope that we don't. And if we do, I'm concerned that how long this is going for, it's just going to lead to a whole set of problems. And that isn't just the immediate ones of some businesses not being able to be open, and the corresponding pressures of revenue and their continuing expenses, but even just what happens with the government's reaction to another shutdown. Because I think that would mean more stimulus, more spending, more money printing. And considering everything that we've had to go through in the last 2 years, I'm concerned that all this spending is just going to lead to some sort of inflation. And even though the feds are saying it's transitory and we should be able to get a handle on this, I'm still concerned that this is more than just a short-term transitory problem. And I like really I shouldn't say the only, but the biggest ammo that the feds have to fight inflation is just increase in interest rates. So I think that that's coming. I think we're going to see inflation in the near term or continued inflation in the near term. I think we're going to see upward pressure on interest rates. And this is just status quo. Like this is if nothing else changes in what we're dealing with right now. And like interest rate increases is not good for real estate because it's now costing that much more to borrow. That's I think that this happens anyways. But if we have to do another round of shutdowns and lockdowns and the government prints more money and adds more to it, then I think that just adds another level to inflation and that trickles down to interest rates. So that's probably the biggest risk that I see right now. But I mean, you mentioned it as well. Like there's so many areas where we could be terrified of. We could be the geopolitical risk, economic risk. It's endless. And I guess the only solace that I take in myself is that in the 16 years that I've been in this business, there's always been risk. Every you could open a newspaper at any day over the last 16 years and there would have been the media trying to sell us fear about what's all these bad things going on. And I think that that's a reality that we have to deal with, is that there's always going to be that risk on the one side, but that's what makes a market. It makes a market that there's going to be people that look at that risk and say, okay, now we're sellers. And then there's people like me who are more optimistic and I'm not ignoring, but maybe suppressing that risk and mentally, who are saying, well, now it's time to buy. Like I see a lot of reasons to be optimistic on this. So I think that's what actually makes a market, is that you've got people that are fearful and you got people that are optimistic. And that does, the fearful part does weigh on me. I am cognizant of that, but I still balance that by just thinking that over long term, there's going to be blips on the radar. There are going to be things that manifest like we saw this last 2 years. There are going to be issues that we have to deal with, but over the long term, US and Canada have shown an amazing ability to keep trending upwards. So I'm still optimistic long term, but that to answer your question, that the interest rates being the ultimate outcome, I can see interest rates going up at some point in the future.
Yeah, amen to that. No, I hope to God that just the mental fatigue of the shutdown, start, stop, start, stop, starts, and it wears on you, and eventually people get numb to the noise, and just it's really hard to marshal anybody to get them to go after you continue to whether you call it flip flop or change. And I know the science continues to change that, but still, it's just people like a message of here's where we're going, here's how we're going to get there, and just stick to it and work through it. But it's just weary. But I hear you.
One other thing that I would add too, Darren, because I did actually want to just address the insurance issue, because that is your podcast. I think having an insurance broker such as yourself on your team is probably the most underrated position that people try and fill out their team when they're buying property. So they'll likely have a lawyer, they'll have an accountant, they'll have a banker, they'll have a broker, but a lot of investors, specifically first-time investors, underestimate the value of having an insurance broker like yourself, and they tend to treat it more as a commodity where they can just go out to 5 different companies and get 5 different quotes and they just choose the cheapest one. I did that early in my investing career as well. And once we secured an investor broker, an insurance broker to work on that, we've built an excellent relationship with him, where now anytime we have a question regarding insurance, and there's a lot of complexity, as you'll be the first to say, on insurance, on even on industrial, if you change a tenant that you have in there, that could change the insurance policy. So you could go into that, I'm sure, in depth, but there's a lot moving in insurance, and if all you're doing is chasing the cheapest quote that you get, you're not going to have anyone like yourself who can actually direct you through these challenges and these risks. So I'd encourage anybody, add an insurance guy to your team, because it will make your life so much easier than trying to just get the cheapest price out there.
No, I appreciate you saying that, because it's definitely a moving target, and the information changes all the time. And like you said, tenant selection can create complications for the insurance, and then a lot of people don't think about that up front. And it's only when you have a claim and it's not covered that then you're really mad. So I got it. Chad, where can the listeners go if they'd like to learn more or connect with you?
I started a YouTube channel about a year ago. So it's just my name, Chad Griffiths, CRE. And as you could tell, I just love talking about industrial real estate. So I decided to start it a year ago just to address challenges that people can come up with and talk about terminology and just really try to fill a gap in the market where there isn't a lot of information on industrial real estate. And I like to pride myself on the fact that I don't talk about my company. I don't even say what city I live in, because I don't want it to come across as a commercial for my business. I want it to be a standalone product where I'm just trying to add information and value to anyone that's interested in it. So if even if you just search up industrial real estate, you'll probably come across my channel, because there's not a whole lot of people talking about it. But that'd be the best place to go.
Awesome. Well, I will certainly check it out myself. Chad, I want to say thanks for taking the time to talk today. I've enjoyed it, learned a lot, and I really appreciate you going in depth. I look forward to doing it again soon.
Yeah, likewise. And thanks again so much for having me on. And if I'm in Portland next, like we talked about earlier, it's been 2 years since I was there, but next time I'm in Portland, I'll look you up and we'll try and grab a coffee.
Yeah, no, look forward to it. All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.